Good afternoon, Erol. Good to see you again.
Phil, glad to be here.
Today, we have a special guest joining us, Mr. Tom Gdowski, our President and CEO. Welcome, Tom.
Hello, Phil. Erol.
Glad to have you.
Nice to be here.
Tom was the first eager recipient of an invitation to join us on More Bang for Your Buck. Can't thank you enough for being here. Tom, could you give us and audience a little bit more of your background and how you got to Equitable Bank?
Sure, Phil. It's been a little bit of a journey going back about, I hate to say this, 35 or 40 years. So back in the mid-'80s, started out in the investment business in Omaha. Spent 9 years there working for several small regional brokerage firms. Ended up at Norwest Bank. And
Now, were you at Norwest in Omaha?
in Omaha.
Okay.
Worked at 17th and Douglas. That location's now being converted to apartments, I think. Basically did a lot of fixed income trading for their correspondent banking desk. Worked with a lot of fixed income securities. Back in those days, ended up got an opportunity to manage a bank portfolio out in central Nebraska back in '93. Took that and managed that portfolio and did some other things for the bank, and joined Equitable in 2005 and became the CEO in 2009.
Now, when you joined in 2005, were you doing the same thing, managing a bank portfolio?
No, Equitable at the time was doing a public stock offering, so we were raising capital, and I was in the process of helping expand, supporting that stock offering, and bringing on new locations to Equitable. So we opened up a location in North Platte, opened up a facility in Omaha, and at the time when I joined Equitable, it was a traditional thrift. So basically they made home mortgage loans and financed them with deposits based out of the community. So that business model wasn't the direction that the bank wanted to go, so they wanted to be more of a commercial and ag bank, and they were doing a stock offering. I had a background in that, so the timing of it worked out pretty well.
Okay. That's good to know. Having been the newest person to Equitable, obviously amongst the group here, I didn't realize that Equitable wasn't always doing commercial and ag loans. I know the history of Equitable is in your traditional thrift with the home mortgages, but I didn't realize that's a more recent transition for the bank.
Well, I guess it is recent. Equitable being around 140 years, and for about 120 of those, 125 of those years, did make a living. And as you probably talked about in the background of Equitable, back in 1882, they formed an association to start building homes here in Grand Island.
Right.
And provided financing. As soon as they'd get one house built, they'd go down, and the people that committed funds and savings to support the house, to build Erol's house, when they got his house built, they went to you. And that's how financing got done back in the day. Fast forward that, and prior to the early 80s, mid-80s, banks weren't allowed to do mortgage lending. So it was something that was done solely by thrifts. So when you look at commercial banks now doing mortgage lending, It's a normal course of their business. But back when I got started, banks were dipping their toe into the mortgage business, not sure they wanted to get into it. So it's been an evolution of the financial services, which includes banking and investments. That probably is why I ended up here, starting on the investment side and working with investments, fixed income, securities. That interest rates were higher. So, it just was a matter of, when you look at Equitable and how they morphed into what we are today, $450 million, doing the commercial and ag lending. We still do a lot of mortgage business. We have a great mortgage department.
Right.
And service about $160 million in mortgages that we generated here in Grand Island, North Platte, and Omaha. So, to answer your question, we needed to change the business model of Equitable to stay current with what our customers need. And it's worked out pretty well.
I just, being a younger individual who, for as long as I've paid attention to banking and finance, to me, a bank's always been a one-stop shop. I mean, as long as I've been in banking, when you went to the bank, you could get your your home mortgage. You can get a checking account. You can get a business loan, or maybe not necessarily an ag loan, because some banks really tend to stay away from agriculture because it is highly specialized. You really have to understand agriculture. But from what I'm gathering from you, prior to the mid-1980s, you had to go to a specific bank for your home mortgage. You couldn't just go to wherever you had your checking account and get a home mortgage.
Yeah, and a bank is a general term. You call it a bank, but if you go to it's Equitable Federal Savings and Loan was not a bank. It was a savings and loan. There are still savings and loans that operate that way. They call themselves a bank, and they do offer checking accounts, and they do offer mortgages, and you can get a commercial loan there, but they are technically operate as a thrift. And that's getting a little bit deep into the weeds, but it ties back to the charter that they have to operate. The question that a lot of people don't realize is in the 70s, the federal government set both deposits, they set deposit rates and they set loan rates. And those were primarily for commercial customers, and mortgage rates were obviously done by the thrifts. So when deregulation hit in the mid 70s, early 80s, with interest rates and other things impacting financial services, those regulations went away, and banks were then allowed to make mortgage loans. And they got more into consumer lending, because prior to that, they didn't do any consumer lending.
Sure.
So as an example, in the early 90s, the Federal Home Loan Bank system today, which most people don't really understand what that is, or they have any reason to understand it. But the Federal Home Loan Bank system's similar to the Federal Reserve Bank system. And those are both, the Federal Reserve Bank system obviously is there to regulate currency and regulate the supply of money and interest rates. So when that all changed in the early 90s, and now banks could get into home lending, and it opened up the ability to join the Federal Home Loan Bank, that's when the door really opened for commercial banks to play a bigger role in that.
Interesting. Because, I got into banking in, let's call it, 2010. And I think Erol, talking to you, 2006? 2006 when you got into banking. So, in terms of experience for the environment in which we're currently in, because one of the more pertinent topics of today is just that. It's interest rates. I always like to say anecdotally, I can get an idea of what the current business climate is based upon what my friends, family, and customers are asking on a regular basis. And right now, Erol, I don't know about you, but it seems to be, if we're not talking about inflation and how expensive food or whatever it might be is getting its interest rates. Well, what are interest rates doing? Where are they going? What in the world is the Federal Reserve? Why does this matter? Because I had so many people call worried that, well, the government raised interest rates 0.5%, so the mortgage rates went up 0.5%. Well, no, not necessarily. There's a lot of nuance to what the Federal Reserve is doing when they raise interest rates. But really today, I hope to talk about just that, interest rates. Why does this matter? Why does what the Federal Reserve's policy? How does that impact the average person on Main Street America? And why does it matter? What do they need to look at? What do they need to pay attention to? And if they don't have a relationship with a bank, how can a bank help them navigate the changing time that we're in?
Right. And I was excited, the topic of interest rates and your wealth of knowledge, your experience, but share with our viewers too, just your experience when you got into banking. Where were rates, if you can recall, and then what have you seen along that journey over 35 years, kind of fast forwarding to today?
Well, to give you an example, let me answer the question this way. If I could guarantee you a 12% return for the next 5 years with no risk, would you take it?
Yes.
Absolutely.
So given that the market right now is down 15% year to date, January through May 11th, May 10th, when I got in the business, you could buy an insurance fixed annuity. Transamerica had a 12% 5-year fixed rate. And
what was a home loan rate then? Because I always have to try to relate to something.
15 to 16.
Okay. And what was prime? The Wall Street Journal.
Prime was, I believe, in the 15 to 16% range.
Okay.
I think it hit as high as 18. I'm not exactly sure, but that was in the right in the early 80, 81, with Paul Volcker was the head of the Fed, and they did what they're on a similar course we're on to now. So they drove rates very, very high to slow down inflation. Of course, they went out the gold standard in 1970, which is, a lot of people would say that's why we have such an inflated balance sheet today. But when I got in the business, my first home loan was 9.8%.
That's probably
And that was in 1985. And I thought I stole it. I mean, I thought I got
free
the best
money.
deal.
This is great.
And so on a relative basis, I've spent my career in a 40-year bull market in interest rates,
Right.
going from 18 to 0. I never thought I'd see 0, but the pandemic, and one of the reasons why interest rates is so pertinent now, and you guys are talking about it, and it affects your business or and what you're doing at the bank, and when you work with your customers and calculating debt service coverage and calculating what interest expense is and what the impact is on their ability to repay, obviously it's very important. So as it relates to, in terms of my history in a bull market, I see it. I can remember, and you guys hopefully have relatives that have money saved and they look at their nest egg as a source of income.
Right.
And back when rates were 10 to 15%, and if you had $100,000 in a CD and you were getting $15,000 a year,
Meaningful.
it was very meaningful.
Yes.
And as we saw rates, we've seen two things have happened. Rates have declined over the last 30 to 40 years. And what has happened is that's really been painful for the saver.
Right.
Because they used to get 15,000, well now they're getting 1,000.
Yeah.
And what has happened to inflation? It's went the other way. So the cost of living has increased, obviously, fivefold at least. And obviously their source of savings has been evaporated because of inflation, and the ability to provide any income for them goes away.
Right.
So there's two things that interest rates affect. It's the saver and then the borrower.
Right.
Well, and to me, what we've been in is the only normal I've ever known. I started in banking on the heels of the financial crisis, and I was telling Erol last time that when I joined Equitable, I was excited to be joining a bank and coming back into banking at a time where interest rates weren't zero, because my entire banking career prior to that, I had never had interest rates basically not be zero. And I feel like I was bad luck, because I no more than joined, and then COVID blows up, and the Fed has the emergency meeting, and lo and behold, we're right back at zero. So I never did have the opportunity to start with rates above zero. But as the past couple months have transpired, we started this year still at zero. And the thing that I've noticed is we went from, we're going to continue to monitor the situation. This is the Federal Reserve who sets the interest rate policy for intrabank lending. We're going to monitor. We're staying the course to, oh my, inflation's a real problem. We need to do something about this. And it's that rate of change from zero to more than zero, and the idea that over the next year or so, the Federal Reserve is telling us we are going to continue to hike rates, and hike rates aggressively, until we see a meaningful change in the inflation numbers. And I think, because historically speaking, from what you're telling us, your first home mortgage was 9.8%. Today, that number is still got a 5 in front of it, so historically low. But I think what has people most concerned and making it such a topic of conversation today is the rate of change that we've seen from the beginning of the year until now, about halfway through. I mean, it's night and day difference between the rate environment that we started the year at to what we're at today to what we anticipate by the end of the year.
Yeah, it's going to move a lot. I think the Fed has been pretty clear that they're going to do what they got to do to get inflation under control, and they're currently projecting 8% plus in the CPI numbers. So they've forecasted that we've all heard it, 6 to 7 rate increases of 25 basis points to 50 basis points, depending on the amount and timing of those will depend on how fast rates go up. But it's going to have a big impact this year in terms of for your customers. You know, when we look at helping customers with businesses, or certainly the home mortgage market, is the goal of the Fed obviously is to slow down the economy. And we're going to hear the terms about, which we haven't heard for a while. You mentioned the financial crisis.
Right.
You know, when that happened, the Fed, you guys remember the cash for cars or
Cash for clunkers. I do remember that.
Cash for clunkers. First-time home buyers could qualify for an $8,000 credit to assist them with a down payment. You had cash for clunkers.
That. Yeah, cash for clunkers I remember very well. Yeah.
So obviously coming out of that cycle, the Fed was extremely worried about the long-term impact of the economy, so they flooded our economy with liquidity in this basically lowered rates to create demand. And it worked, and then rates went down and had stayed down until right before the pandemic. And the Fed at the time, right before the pandemic, Fed funds were 2.5, and they were talking about them going to 3.5 to 4.
Right. We were just coming, because everything I've known about interest rates and monetary policy really comes because I think the financial crisis really started just a whole new regime in terms of how involved the Federal Reserve is in looking at the economy, the stock market, because I feel like in years prior, it wasn't necessarily their job to keep the stock market propped up. They seem to focus more on employment and inflation. And in my life, I feel like they've been very in tuned with what the stock market's doing too, because we haven't seen that inflation. So it's like they didn't have the issue of inflation and employment was okay, so let's focus on something else. Am I wrong in my perception of that?
I think you're going to see the Fed much less interested in the stock market than they are controlling inflation, which has a lot bigger impact on the average person. And everybody hates to see volatility in their stock portfolio. But in my opinion, the Fed's they're going to do whatever they have to do to get inflation under control. And so I think we're going to see them raise rates 200 to 300 basis points probably within a 3 to 4 month period. And that's going to have the effect of pushing prime and home rates, like you said, over 5, 6, 7. Is that still cheap? I don't, you guys know what cost per square foot to build a new house is.
Right.
So when you add on 2 or 3%, I think the average house, if I saw this correctly, the average home in America is $450,000. It's probably around, if you build a house today, what would it cost you in Grand Island or Omaha?
I think all of that.
All of that.
Yeah.
And so that's a fairly modest house. So if you get a conventional mortgage, put 20% down, or if you get an FHA and put 6% down.
Sure.
So you're still going to carry $350,000. Let's call it $400,000.
Round numbers.
So add 2% onto that.
Yeah, it's
$8,000 divided by 12. So you're talking about another, $500 a month, $700 a month that you're going to have to come up with in terms of after-tax income to support that house payment. That's going to have an impact in housing.
Well, it has to, right? Because at the end of the day, there's only so much money out there. You only have so much disposable income to work with, and I think the one thing that shocked me most throughout the pandemic, because there's that period in March where none of us really know what this looks like on the backside. We don't know how severe COVID is. We don't know what the overall impact is going to be. But I remember watching, housing prices started to trickle down. People that were trying to sell panicked and just tried to get out of their house if they were. Obviously, the stock market rolls over. But then I don't know if it's April, May, June, sometime in there. It's like we see the light at the end of the tunnel potentially. And all of a sudden, housing prices start doing, they went parabolic in a way that I've never seen before. Even prior to the great financial crisis, housing prices were going up quickly, but not this quickly. I think that the stat one of our home mortgage lenders shared with me the other day from a metro market in Arizona, that the housing price increased 26% the last year, and they're still forecasting a 21% increase this year. Now, I see that, And I think, well, if the cost to borrow to buy that home is going to double, how can that be sustainable?
Well, it's not going to be sustainable, so that's going to be the challenge for the economy. And as another example along that line is, I believe the average house payment on the standard home if you use pre-pandemic numbers, March 2020, and let's just say that your payment was $2,000. Fast forward, the same house with now add in inflation and higher rates, your average payment went from $2,000, it increased $1,800 to buy the same house till now. So now instead of $2,000, it's $3,800.
Oh my.
Wow.
So,
and how fast can wages come up to
right.
support
So
that?
if the discussion, if you're talking about interest rates and the Federal Reserve, obviously, what impact is that gonna have? It's got to have a slowdown on the economy.
Certainly has to.
So as it relates to the consumer and everybody trying to borrow money, hopefully they may look today and go, geez, I can't afford 5% is terrible. Well, that actually might be cheap.
Right.
Right.
At the end of the day, 3 years from now, you might go, wow, I could have got a 5% mortgage.
Yeah, how do you know? And I think I always try to relate back to the consumer and our customer. We're talking a lot here about rates are going up.
Mm-hmm.
Inflation is here. To me, a fixed rate home mortgage is, if you are privileged enough to have a home, to have a fixed rate mortgage, maybe during the pandemic when rates were at rock bottom levels, you were able to refinance at 3 or 3.5%. One of your biggest risks in this inflationary environment is covered. You locked in the price of your house when you bought it, and you really locked in that payment with that long-term fixed rate mortgage. So for homeowners, I think they've got a little bit of coverage in this inflationary environment. Now, granted, they're not locking in their food costs and maybe their transportation costs long-term. That's something very difficult to do. But I would say that the largest portion of your average American's budget is housing, whether that be rent or your mortgage payment. So I think as a takeaway from what's going on now with inflation and rates going up, if you are someone that is fortunate enough to have purchased a home prior to this massive run-up in prices, and even if you were in on that run-up but got one of these really super low-rate fixed mortgages, you kind of won on that.
Yeah, it gets hard to move.
It does. It really does.
Yeah. Another industry that's been hard hit is the automotive industry. Used car values in the last couple of years have skyrocketed.
Yeah.
And there's a lot of reasons why, but supply chain is really a continuing ongoing issue in America, driving up. They can't get computer chips for those new cars.
Right.
So they're sitting there waiting to be sold, but they can't.
Right.
Erol made a good point on talking about you can't afford to move because of, which affects all of us. 70% of the outstanding mortgages in the country are, I believe, 3.25 or less.
Wow.
Seriously.
Yeah. So
Wow.
Fortunately, a lot of people were able, if they did buy a house, were able to lock in a lower rate. But to your point, it's going to be interesting to upgrade. When I was young, I had a realtor in Omaha tell me you just keep buying as absolutely much house as you possibly can. And I had a 9.8% mortgage on a 20-year amortization, and with taxes and insurance, my payment was, and it was a modest house, 1,600 square foot, split level, 149th and Blondo.
Yeah.
My payment was $820. And that was all I could afford. And so, then we stayed in that home for 8 years. We didn't take her advice, unfortunately, because houses did increase. Well, actually, maybe not. We stayed in that home and moved out to Grand Island after 8 years. But to the point is, yeah, if you wanna now move, if your average house is $250 to $300, and you think now I've got a family or whatever, 2 kids, 3 kids, whatever, I need a bigger house.
Sure. Yeah.
You're gonna have to go to $400,000 to $500,000.
Well,
probably to not get that much more house and refinance
Right. The rate
for the average person.
Yeah.
Yeah. And what I hear a lot is I can't build my house today for what I would sell the exact same house for today.
Right.
So I think that's the litmus test right now of what do I do?
Well, it comes back to opportunity cost. I mean, there's a trade-off in everything. Mm-hmm. It's, do I love this home? Do we need more space? Maybe we need more space, like you say. Life happens, kids, whatever it might be. Maybe you've got a parent needing to move in because of their housing situation. Especially if you purchased 5, 6, 7 years ago, I don't want to say you're trapped in your home, but depending on your circumstances, it might feel that way.
Yeah, hopefully you like your house.
Yeah.
I paid, for my first home, I think I paid $68 a square foot. The one I live in now, which I lived in since 2005, I paid $51 a square foot. And I think to build a new residential construction was probably $300. Yeah. So I could afford to do some improvements to it.
Right.
And it's bigger than I need now.
Sure.
But if you look at the effects of inflation and everything else, there's no way that I could do that. The other thing that kind of bothers me, it's not so much interest rate related, but it's taxes and insurance.
Right.
Because everybody we talk to, what's my mortgage rate? I just had a niece and nephew bought a house, and they're like, they're so focused on the interest rate, but they tend to forget about taxes and insurance until you get that first bill.
Right. What's the payment?
And
what's this escrow thing?
Right.
Why is escrow taking so much of my payment? Yeah.
So, it's going to have for the housing market, that's going to be a challenge. I think for the business market and the rental business, it's also going to, obviously the debt service required to buy an investment property and rent it out, to the point you got to pass on that higher expense to the renter. And so, that puts more pressure on them as well. So, the goal is hopefully they can get inflation becomes stabilized and we get more into but it looks like it's going to be a pretty rocky ride here the next 6 to 9 months until we get the Federal Reserve feels comfortable that they've got some kind of handle on inflation. The only thing we haven't talked about is when we had the pandemic and they pushed rates to zero, basically they've pushed demand out.
Right.
They advanced, and so as that demand that's been created artificially gets absorbed, it'll create a little bit of a rough ride that we're probably going to live with for a while.
When I think about credit, and I haven't quite figured out how to correlate it, but there's a time component. I need to buy a car today. Now, my options are I can take the next few years and I can save money, and then I can go pay for that vehicle, whether it's 5, 10, 15, whatever it costs. You can put off today, save, and buy in the future. But what credit allows you to do is make that purchase today and then pay for it in the future. And when rates are zero, the trade-off is nothing. I mean, I know during the pandemic, you had rental car companies having massive liquidations because no one was renting cars. You had auto manufacturers that had vehicles pushing, 0% financing to bring those sales forward. And to your credit, what you said there is a lot of things were purchased during the pandemic, whether it's home improvements, new houses, vehicles, whatever that might be. Now, as the cost of money goes from nothing to something, more than nothing, you have to believe at some point that changes people's attitudes towards spending money.
Yeah. And, from an industry perspective, sometimes that, I call it the behavior, but your spending pattern, those things that you're accustomed to are the last thing to change,
right?
Which causes sometimes, those financial hardships, and encouraging families to be mindful of that now, kind of that prudency that we talked about last episode of making sure that you, as a consumer, you really understand the impact of that on your finances, because our wages aren't going to increase as fast as inflationary pressures are going to drive up prices.
Sure.
Right. And let's just say I can afford this car today, but 90 days from now, that could be a much different discussion.
Sure.
Based on the cost of borrowing money, what does that do to the payment, and specifically with a house, right? Well, I was pre-approved for a $400,000 purchase price in December. Well, if your income hasn't changed, that purchase price just came down quite a bit
Significantly.
in the last 5 months. Right. And over the next 5 to 9 months, that's going to come down even further. And so, again, one of the reasons I was excited to be part of More Bank for Your Buck is making sure that we have these tough discussions, and we are encouraging, the audience, our viewers, to understand the impact of these discussions on their lives, right? And kind of where does rubber hit the road? Encourage our viewers to ask questions, to engage us so we can address those specific concerns in future episodes, because interest rates is timely today. I think it's going to be a timely discussion probably the rest of this year.
I would agree.
Well, probably a lot longer than that, because it's going to have a big impact on the consumer's life, to your point. It's going to become and to Phil's point about free money, doesn't matter.
Right.
But it's going to become a lot more major. I can tell you, when you get a 10% mortgage, and you're borrowing $400,000, that's to me, who's been around a little bit longer than you guys.
Sure.
But that is a big number.
And there's some resources we can share to our audience too. We'll tag them in our comments, but there's resources out there that what does that payment change when rates go up?
Right.
And we can provide our viewers with those tools to click and I always say play with the numbers.
Right.
Understand if these are the purchase prices, these are the interest rates, what does that mean to my payment? Because I think at the end of the day, that's what matters the most.
So the other thing you're going to see, the only other way to get the monthly payment down is to do what, right? Stretch out the amortization.
Mm-hmm. Right.
So right now, if you do a mortgage loan with any bank or financial institution, they generally originate that loan and sell it. We service all of our loans, as you guys know, and I think what you're going to see is the federal government start to allow 40-year amortizations on loans will probably become a lot more common.
Did I hear that in Hawaii, do they have 100-year amortizations in Hawaii?
What?
I think I heard that
I've been there
somewhere.
for a while.
I know it's a lot longer than 30 in markets like that, but I wonder, do you think we go back to the interest-only loans that were maybe part of the issues preceding the blow-up in housing in 2008? Do you think we get to that point where, because like what Erol said earlier, if you were pre-approved for $400,000 in December, I don't know the exact numbers, but I would venture to guess that number is much closer to $300,000 today. The only issue being, I can promise you that home prices have not come down from December until now. In fact, they've probably gone up just a little bit. So your access to affordable housing is shrinking.
Well, I think if you go back to 2008 and the last financial crisis, of course, that was driven a lot by fraud. And so terrible monetary policy, terrible governance in terms of no doc loans. I mean, we didn't do it in Grand Island, certainly not Equitable, but you could walk into Phoenix and didn't have to, they were called no stated income loans.
Right.
You walked in and
this is what I make and this is what I can afford. Sure.
All right.
Here's your money. And
they literally were doing those type of loans. Obviously, they have no ability to repay.
Sure.
And they never disclosed to borrowers on when they got into those adjustable rate mortgages. And it's probably appropriate you guys talk about that and people are aware of it, because you're probably going to see those teasers come out again. As things slow down, you're probably going to start to see those teaser type rates. And they got to make sure that what happened the last time is they were teaser rates for a year, 2 or 3, and then jump to prime plus 3.
Right. So you might get in today at 3% for a few years, and then it might jump to
that's what it did.
Yeah.
So back to the 2008 time period in housing, I was golfing up at one of the courses out in western Nebraska. This is 2010, and they required us to have caddies. And the guy I was with, he used to be a mortgage lender, in Arizona. And I said, why aren't you doing that? He was from South Dakota. And I said, why aren't you doing that anymore? And he said, I got tired of lying to people and making them loans. I knew that they were going to default and not be able to afford their house within 2 or 3 years. And that's exactly what happened.
Right.
And so I don't think, hopefully as a country, we're smarter than that this time. But when you talk about this speed, the Fed's talking about correcting this inflation problem, it's going to slow demand down quickly, and they'll be pulling out when they try to get the pump going again. It'll be interesting, some of the unique financing that becomes available. I would just buyer beware when you take out that mortgage or commercial loan, whatever type of financing you're doing.
Well, and I think that the silver lining to it is having that person that you can talk to and have this discussion. You know, whether it's your commercial lender, if you're a business owner, okay, maybe you have some borrowings, or, you know, talk to your banker. Are those fixed? I mean, what is the horizon for my interest rates on this loan? Because if you have it locked in for the next 5 years, I think you're in a much better position to weather these cycles moving forward. If, as we talked earlier, if you're in your home and you bought it before prices went up and you have one of these low interest rates fixed in, you're in great shape. You know, looking forward, you're in great shape. I mean, this discussion matters, but it doesn't hit your pocketbook like it does your first-time home buyer or someone that is in the process of maybe moving or needing to upgrade their home. So I think there are, you know, some glimmers of hope in this. We're in a changing environment. You know, nothing's ever constant. You know, this won't be here forever. We're going to go through this tightening cycle, as the Federal Reserve would call it, to slow down the economy, to slow down inflation. But I think it becomes even more important to have these conversations. Maybe it's your personal banker, your financial advisor. You know, you talked about how, you know, the past 15 years, it's really been the saver that's been in tough shape. Well, now things are starting to look a little bit better for them.
And I think that's, and I was going to mention that, we've talked a lot about the borrower, the saver, which is people that are in retirement, maybe pre-retirement. They're going to see big changes in their bond portfolios, which they own typically through mutual funds.
Right.
And when I got started in the business, the first firm I worked for, you weren't allowed to sell a mutual fund. It was all individual securities, stocks, and/or bonds. So in today's world, it's all mutual funds. So if you need, the average investor will say, what do you think of the interest rates and what is its effect on my portfolio? They really don't realize that they own longer term bonds than they think they own. So the average mutual fund investor typically has, they've got a portfolio of bonds that might have a 4 or 5 year maturity. Well, if rates go up 100, 200 basis points, we know what happens to the value of a bond, right?
They go down.
They go down.
They go down.
So, you know, I think investors in this year, bond investors or stock investors, are getting hit with a double whammy.
Yes.
Normally one side of your portfolio offsets the other. It's not very often when both markets are heading south.
Right.
Yeah.
So I hope, you know, and people now, when rates were zero, a saver, what difference does it make if I get 50 base, 0.5% or 1%?
Right.
It doesn't amount to much to care about. So as we go forward, it'll be much more important if rates go to 2, 3, 4, 5%. The savers out there are going to be presented with opportunities that they need to go into them with eyes wide open, know what they're buying.
Right. And
Yeah.
I would say, you know, too, I feel we're very fortunate to be in Nebraska. Unemployment's under 3%, right? Housing markets are stable. There's not a lot of uncertainty. You know, when I'm talking to business owners and families, there's not a panic, right? There's not this sense of, oh, the sky's falling, rates are
impending doom,
right, are climbing. And, you know, to me, that's, again, another value that we as community bankers and our bank brings to the community is is there is a lot of positive things happening in our communities, in our businesses, and just because rates are coming up, right? And inflation is going to bring, consumer goods costs up. The sky's still not falling. There's still a lot of growth potential out there for small businesses to grow and to grow profitably, and for professionals and entrepreneurs to start endeavors, right? Still start new businesses. And to me, that's what we're here to continue to find ways, regardless of market conditions, right?
Sure.
Regardless of interest rate environment, understand the risks that can impact that endeavor, and speak into that honestly, candidly, pointing out, from our perspective, here are some things that concern me, right? Here's what would keep me up at night if I was in your shoes.
Sure.
And then how do we mitigate that?
Right.
That's part of what we bring to that discussion. And to me, yes, there are some things that worry me, but there's still a lot of positives in our city, Grand Island, North Platte, Omaha, but really our state as well.
Right.
Well, they don't broadcast national news out of the Midwest.
Right.
It's broadcast on the coast. So everything, when things are going tougher here, they generally going pretty well on the coast. When things are bad on the coast, things are they don't get as bad here. So the stability of our economy, heavily ag influenced, we all have to eat. And we don't get the hysteria that you see on the coast. So
More stable, I would say.
it is much more, Midwest has always been much more stable. And, the other thing is its effect on inflation and its oil, and obviously that, oil going, was it like a year, maybe it seems like a year ago, 2 years ago, they were giving oil away, and now it's over $100.
Yeah.
So, that's going to have that just tells you kind of where we've been the last year or two. So it'll be interesting to see how it all washes out.
Interesting times, to say the least, which leads us to a segue for our next episode, in which we're going to talk about Tom's favorite topic, I know, cryptocurrency. One of the questions that 2 years ago, I don't think I heard a whole lot about it, but here more recently, more and more people are asking, what is cryptocurrency? What is Bitcoin? What does this mean? And should I be investing in it? So I think we're going to try to take a little bit of time to bring a 1,000-foot view of what is cryptocurrency, why does it matter, and how does it impact our customers?
Yeah, I know very little.
We're going to learn.
It's a hot topic.
It is a hot topic.
Yep.
Until next time, please like, subscribe, and share. Thanks for listening to More Bang for Your Buck. Thanks, Tom.
Thank you.
I want to thank our audience for joining us today on More Bank for Your Buck, and looking forward to our next podcast together. Phil?
Sounds great. Thanks, Erol.
My pleasure. Thank you.